We believe at Blanke, Schein Wealth Management that information is power. Our goal is to provide our clients, friends, and family with real-time and relevant market-related information. Our process creates smart and purposeful financial decisions that improve. Director and partner of Blanke Schein Wealth Management. Well, today is June 25th, 2020. We have three topics in this audio edition only to discuss with you today, from weekly jobless claims to 3-month lows off the market bottoms and what's next. So thanks for listening and looking forward to having a great conversation today. Our first topic of the day, U.S. weekly jobless claims total 1.48 million versus the 1.35 estimate. While initial claims expected in this weekly update, the overall week ending June 20th report of 1.48 million is showing a continued decline in the weekly claims. So we've seen, again, this is another week over week of decline in the rate. Even though the economists didn't quite get the estimate correct, it's still a decline. So the economists are looking for a little bit quicker and healthier improvement by their 1.35 million estimate. We're still getting, we were lower than last week, and we're still trending in the correct direction. I think markets are looking at that today, and they're positive as we get close to today's trading day, as the today ends rather shortly, close to 1 o'clock right now. My second market-related relevant topic. Again, there's a bunch of headlines out there, but as we look at what traders are watching, what markets are paying attention to, we only want to bring you what we believe that the markets are paying attention to that move markets as it relates to managing our portfolios and managing our clients' assets. This one is something I continue to bring to the forefront. Again, it's updated on the Fed's Bazooka. The Federal Reserve, keep in mind, in February, the Federal Reserve and fiscal and monetary policy worked together to provide $7+ trillion in not only money to hands of individuals as well as small business owners and all those facilities and programs, but the Federal Reserve also has lending capability on its own in concert. So they're working together. And they gave the update right now that said in March they unveiled the program that said they could provide up to 2.3 trillion on this to the economy in loans from a lending capacity in just this one little facility and program, which isn't insignificant. That's a huge number. But so far they reported that they've used only 143 billion, or just 6.2% of the total firepower of that $2.3 trillion. Again, that's where the markets are looking at this, is like there's two things unfolding. One, there is that backstop, as I keep reporting, that the Federal Reserve has that. Number two, the facility hasn't been drawn down, or the capacity is still there. So that's huge, tremendous firepower that's still available if this pandemic, economically speaking, gets worse. The Federal Reserve has done a great job of providing this to be there, but markets have done an even better job of anticipating that this liquidity is there. But it looks like right now, not all the liquidity is being used, or at least needed. And that translates into the economy is working its way through this versus it being a huge stress or a strain on the economy itself. Now, there are pockets and there are very specific small businesses and there is unemployment to deal with. But this means that the Federal Reserve still has that capacity to help, not only in the short term, but in the years to come, as they will have to probably to use, a lot more than they're doing right now. So that's a positive that the market sees that there's additional liquidity. It means that they didn't use it all. It's still there for an additional 2.3 trillion, if you will, because they only used 6.2% of that. My last topic of the day is a research piece from Chris Rohn, strategist. He's always done a wonderful job, and he provided a piece to us this morning, basically talking about the 3-month. We're off 3 months off the lows. Now what? And he recapped that basically while the gains have been tremendous over the last 65 trading days, again, it puts the S&P 500 in the third best gaining period stretch in history, and it's at 36.3%, coming from its March 23rd low over this last week, if you will. But that's just under the 38.8% from the 2009 low, which is the historic all-time best. So we're still in the quarter, and there's still room to run, and markets are up today. So we could see this is the best 3-month stretch in history. So time will tell. But what that means is on a forward S&P performance basis, meaning when you have the 65 best days, what Chris Rohn did in his research piece today is he put together all of the times going back, the data going back 50 plus years in the market in the S&P specifically, and said when you have a 65 day percent change of a magnitude of like 20% or greater, what is the next 20 plus trading days, 65 plus trading days, 125 plus trading days, and ultimately 1 year or 250 trading days plus look like on a go forward basis? Well, I have to say that it's all pretty good positive news on the first, with the exception of the next 20 days. So this next 20-day stretch, it's not uncommon to see sort of a pullback or a breather. That average, you took the average of 10 periods in time, and you're looking at a negative 1.8% collectively, some up, some down, but an average of just down under 2%. But if we go out 65 days, you're up about 4.7% on average. 125 days, you're about a 7.6% and 90% positive rate of those. And then you're still 250 days on a go forward basis. You're a 90% positive rate of the 10 times in history they looked at, and it's a 12.2% average rate of return, some being as high as 25 plus percent and some as low as 11%, but the average is over 12%, if you will. So if history is a guide, it's showing on an S&P go forward basis that there's a sort of positive trend if history again is a guide. And as we know in the investment world, history doesn't repeat itself, but it often rhymes as it relates to markets, and we take historical perspective to take a look at that to give us some guidance. And one of the bigger picture items, and the reason why, at least historically speaking, it's been in the past that the S&P 500 on a go-forward basis has been so dramatic and positive, especially 6 months out and a year out, is simply because you've gone through recessions prior to that. And the recessions really warrant the fiscal and monetary policy response. And then post the fiscal policy response and monetary policy response, you then get a rebuilding, if you will, and coming out of essentially a recession that you see. So that's one of the reasons why on a go forward basis, after a crisis or a period of time where there's been a recession, on a go forward basis, the market performance literally defies the headlines, it defies public pessimism, and it climbs the wall of worry. And that's ultimately, if you take a long-term view of the markets, historically speaking, they've rewarded you and they rewarded our investors. So I just want to give you an update today on those 3 headlines. Thank you for listening and have a wonderful day.